Hello traders, Gary Wagner here just before 1 o'clock in Honolulu, 6 o'clock in New York. It is Wednesday, January 29th, 2020, and this is the Daily Report for Gold and Silver. A historical moment as the Federal Reserve met for the first time this decade. What was uneventful was the fact that they did what they said they would do, and they left interest rates where they stand. In fact, we are looking at interest rates remaining steady throughout this entire year, and that will be bullish for gold. The one question that was kind of left unanswered is whether or not the accumulation of $200 billion in additional assets to the tune of $60 billion purchased each month can be called quantitative easing. Chairman Powell says no, but reporters continue to question him and ask him if, in fact, that is what they are doing. In either case, that is also extremely bullish for gold. We do have a strong economy, and the statements made were very, very well taken by not only the equities markets, but the precious metals markets. On today's show, I want to take a look at our trade. I want to talk about our upside target, but first, let's take a look at current pricing. With the exception of platinum, the precious metals scored moderate to strong gains on the day. Gold futures, and this is basis the February contract, is currently up $5.40 at $1,575.80. Of course, our trade is out in the April, closing up $4.70 at $1,580.70. Silver scored about a 0.25% gain, $17.53, and palladium once again had a pretty nice gain, $32 at $22.1790. Let's take a look at our charts. The first chart I do want to look at today is a daily candlestick chart, continuous contract representing February futures. As you can see, when we look at the volume on this, you've got about 378,000 opposed to the next contract month, which is April. But notice how it has spiked up tremendously over the last couple of trading weeks. It's got good volume there. But until it becomes active, we will continue to use this particular continuous contract as our primary chart that we look at. Of course, the Federal Reserve came out today. Their monetary policy is remaining largely unchanged, and so is their asset purchases. That was extremely bullish for gold and the other precious metals. The key to watch in terms of a technical basis is this trend line that I've added, starting from this bottom at 1132 and following it all the way up, and using these series of lows to really define where major support lies in terms of our trend line itself. Now, we talked about the fact that this is probably a counterwave. Typically, a counterwave will go between 50 and 75% of the move that we saw on the way down in A, which is from here down to here. However, there is a type of zigzag pattern, which is the commonly referred term for an ABC correction, called an irregular. I have just put an illustration of the 6 corrective pattern types, the primary ones, and on the upper right hand side you can see the irregular. The key distinction to an irregular is the high that it goes to. The top of B actually is above the starting point of the A wave. And I believe that we could actually see that unfold on this particular correction. And that is one of the primary reasons we're putting our target at 1612. If the market continues to rise, moves to 1594, that 75% level, and stalls in any way, we would take that to the market. But I did want you to have some explanation as to why we picked that particular target itself. My recommendation at this point is to maintain our current long position and to maintain our current stop. On a fundamental basis, the reason I believe that that is a potential outcome is because of the current accommodative stance not only of the Federal Reserve, but of central banks globally. That continues to support gold as it has last year, and I believe will change the fabric of where gold is going this year. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.